I was watching a 2013 Berkshire Hathaway annual conference with Warren Buffett and Charlie Munger, and I really liked this clip, especially for all of the investors and even traders out there who want to see how they think about their investments in terms of how defensible are those investments with their moat, meaning the moat around them that gives them that competitive advantage that other companies just don't have. That way, Munger and Buffett can sleep good at night, knowing that that company is safe, secure, revenues generating, profitability well into the future. But also, what I think is really interesting is how Buffett thinks about different components of his portfolio and the probability that those components of his portfolio will succeed or not. So I'm just going to click play here.
EM investment, where do you see the moat for that business?
I would say that I do not understand the moat around an IBM as well as I understand the moat around the Coca-Cola. I think I have some understanding of it, but I feel I would have more conviction about the moat around a Coca-Cola or a Wrigley or a Heinz for that matter than an IBM. But I feel good enough about IBM that we put a considerable amount of money in it, and there's nothing that precludes both Microsoft, which you mentioned, and IBM being successful. In fact, I hope they both are. I've got enough conviction about IBM's position that we took a very large position. I like their financial policies. I think the odds are good that their position is maintained in a strong way over time, but I don't feel the same degree of conviction about that as I do about the BNSF railroad. I mean, it's very hard for me to think of anything that can go wrong with BNSF. I can think of some things that can go wrong with IBM. They incidentally have.
So right there, just so interesting, because first of all, you can hear him essentially thinking out loud about two different positions or many positions in his portfolio and the probabilities that he assigns to each of them based off of their moat. What I do find interesting too is that he's holding IBM despite not feeling as strongly in their success or their moat or his understanding of the business as companies like BNSF Railroad. Now we know that BNSF Railroad has been a remarkable purchase by Buffett and Berkshire Hathaway. And so he sort of assigns this probability, this degree of confidence into it that he does not assign to IBM, which I think is fascinating. If you are constructing your portfolio, if you are constructing your sort of investment structure, I think what Buffett is alluding here to is the way he positions himself in certain investments and the size he allocates. Now, he does say that he has spent a considerable amount of money on the IBM investment. But when you look at his portfolio and his holdings over time, especially now it's 2024, IBM never reached even close to the amount that he had invested in positions that he was far more confident and comfortable in, like BNSF or most recently Apple. And so what he's doing is he is holding companies that he sees a moat in, maybe sees interest, maybe there's a reason to get involved. Then he's assigning a probability of success on those companies based off of how he sees the moat, based off his degree of confidence, and that is probably ultimately determining how he positions himself, meaning how much money does he actually allocate, what is his position size. Investors and traders often share that in common. You all have a position size in a specific investment or trade, and you do that based off of your degrees of certainty, your research that determines whether or not you think this is going to work out. So I find this just a great open mic walkthrough of how he's thinking about his portfolio, the moat, and then with those two things, his degree of certainty that it will work out or not.
They have a very large pension obligation. Now they have a large pension fund too, but you're talking 75 or 80 billion dollars of assets and liabilities that it is a big annuity company on the side, and you can have balls can take funny bounces in the annuity field. I would rather they didn't have that, but that is a fact that I take into consideration when I buy. They show the assets and liabilities as being roughly equal, but the liabilities are a lot more certain than the assets over time. Charlie?
Well, yeah, well, at least the IBM pension plan has the resources of IBM. But suppose you're a big life insurance company now. All over the world, the life insurance companies have started to suffer the tortures of hell. In Japan, they agreed to pay 3% interest. And of course, there was no way to earn 3% interest once the Japanese policies had been in place a long time. A whole lot of once revered secure places look unsecure now. And around Berkshire, you'll notice the life operations are where we have our own policies as distinguished from reinsurance are pretty small, right?
Yeah, we do not like giving options in this world, and people tend to, well, particularly if they got a sales force pushing them on, as you have in the life insurance industry, they have tended to give people options.
So on this note, you may be wondering, what the heck did they just talk about? Well, this is so fascinating because what they did just demonstrate with that part of the talk was they flipped it to one of their concerns about IBM. Now, if you're an investor, one of the things you always have to be thinking about is what can go wrong, especially if you're committing money to Buffett's size into that company by purchasing shares or other sort of connections to that company's capital structure. But the point here is that what they were talking about was that IBM has a very large pension plan, and that pension plan can either be a great asset to IBM or a really detrimental asset, because ultimately you have thousands and thousands of employees. IBM's been around for a very long time. They owe a lot of these employees specific benefits, whether it's cash payments, monthly payments, annuities, something within this realm. And when it's billions and billions of dollars, well, that can eventually eat into the company in a negative way, maybe taking away some of its income, messing up its capital structure, its cash flows. There's all sorts of potential trouble here. But the reason why I find this so important is because if you watch them think out loud about this entire process, they essentially walk you through their perception of a moat and the companies they do like when it comes to moats. They also then take that information about moats and create a probability that they think the company will succeed, and then assign that probability, and it most likely determines their ultimate position size. But even with all that good stuff being said, you just saw them then dive into the things that keep them up at night, the negatives. And this is what all great investors must do, because after all, someone else is running the company. Someone else who maybe retired years ago, and all the things they did may still catch up to the company, such as a very large pension plan with a lot of liabilities. And so it's really interesting to see them walk you through this whole process and then end on the note of, we are kind of worried about this. It could go either direction, could be a benefit in sense of they have it totally managed. Maybe there's some leftover cash there, or it could be something that, could go wrong. But either way, the whole point here is they have assigned the probabilities of IBM's moat in this specific instance and decided to hold it. Now, recall this video was recorded in 2013. And as we wrap this up, what we can quickly do here is pull up IBM's share price. Let's go ahead and find 2013. Let's just drag here. And if they had held until this entire point in time, they'd be down 8.5% over 10 plus years. Now, why is that so interesting? Well, first of all, it is a reminder that no investor is 100% right all of the time. There's just simply no such thing as an investor who always gets it right. Secondly, what is so interesting about this is you could hear in Buffett's conviction about BNSF and other companies that he knows he feels confident about compared to IBM. Not only that, you can see that him and Charlie both reverted to the aspect of IBM's pension plan coming to mind as a potential sort of headwind, something that could go wrong. I'm not saying it went wrong. We don't know where it stands at this point in time, but clearly it did not exactly have the great effect on IBM stock that they would have hoped. So there's a number of lessons here, I think, to gain. Number one is If you listen to Buffett and you have conviction in something, in this case, as he talks so glowingly about BNSF, well, that's a great time to sort of reflect on what you feel most confident in. Don't let the other companies that you don't know as well, that you're not as confident in, sort of take back your attention in the companies that you really are confident in. Secondly, always be measuring what could go wrong. Remind yourself how quickly they were speaking about the pension plan, possibly a headwind on the balance sheet. And with that in mind, that is also what you need to be thinking about with specific investments. What could go wrong? Because we all like to think about what could go right, the riches, the stock going, up and up and up, turning $10,000 into $100,000. But we forget to focus on what could go wrong. And I think it's really interesting that both Munger and Buffett in this talk were essentially, I would believe if they had rewatched this, they would have talked themselves out of ever owning IBM. So I thought this was a very interesting chat for a number of reasons, and I wanted to share it because it shows Buffett and Munger walking through the concept of the moat, Buffett and Munger walking through the companies they know, Buffett and Munger especially talking about their degrees of certainty or the probability that the company will succeed or the companies in their portfolio, and then lastly, reviewing what could go wrong and speaking openly about it. And I'm sure if Buffett and Munger could rewatch this, I think they might say, yeah, probably should have never got invested in IBM in the first place. We said it out loud at the 2013 conference. Hope you enjoyed this video.